Right now, something very unusual is happening in the silver market, and most people have no idea it's even going on. In just one night, more than 6 million ounces of silver quietly disappeared from major vaults. And almost immediately after that, the CME suddenly cut silver margins by 22%. What makes this situation even more interesting is the timing. This decision came right before one of the most important economic reports in the United States, the non-farm payroll report. When events like this happen so close together, experienced investors start asking serious questions. Is this just coincidence, or is something much bigger unfolding behind the scenes? Before we go deeper into this story, if you enjoy clear and simple explanations about gold, silver, and the global economy, take a second to like this video and subscribe to the channel. Here on Safe Haven Wealth, we focus on helping everyday investors understand what's really happening in the financial world, especially when it comes to precious metals and wealth protection. Your support helps the channel grow and keeps this information reaching more people. To understand why this situation matters, we first need to talk about what actually happened. According to recent market data, around 6 million ounces of silver were withdrawn from registered vault inventories. These vaults are part of the storage system connected to the futures market, where large institutions store metal that can be used to settle contracts. When silver suddenly leaves these vaults, it can signal that physical demand is increasing or that large players are moving metal elsewhere. Neither situation is something the market usually ignores. At almost the same time, the CME, which operates one of the largest futures exchanges in the world, announced that it would cut silver margins by 22%. In simple terms, margins are the amount of money traders must deposit in order to hold a futures position. When margins are lowered, it becomes cheaper for traders to enter the market and open larger positions. That means more potential speculation and more trading activity. This is where the timing becomes very interesting. The margin cut happened just before the release of the US non-farm payroll report, often called NFP. This report measures how many jobs were added or lost in the American economy during the previous month, and it is one of the most closely watched economic indicators in global markets. A strong report can move currencies, bonds, stocks, and especially precious metals. A weak report can do the same. When you combine these three factors together, missing silver inventory, reduced trading margins, and an upcoming economic report that can shake the market, it creates a situation where volatility can increase quickly. Traders know that when the cost of entering the market becomes cheaper right before a major data release, large price moves sometimes follow it. Some analysts believe the margin cut could encourage more buying activity in silver futures. Lower margins make it easier for both institutions and retail traders to take positions. If many traders decide to bet on rising prices, the market could experience a rapid upward move. On the other hand, if traders expect weaker economic conditions or stronger interest rates, the market could move the other way. The key point is that the environment becomes more sensitive to sudden changes. The disappearance of 6 million ounces from vaults adds another layer to this story. In the physical metals market, inventory movements often reveal what large players might be doing before the broader market notices. When metal leaves registered inventories, it sometimes means it is being moved into private storage, transferred to industrial users, or prepared for delivery outside the futures system. Silver is not just an investment metal. It is also one of the most important industrial metals in the modern world. It is used in electronics, solar panels, medical equipment, batteries, and many other technologies. Because of this dual role, both investment demand and industrial demand can influence the price at the same time. When supply inside vault systems begins shrinking while demand continues growing, investors start paying closer attention. Over the past few years, many investors have started viewing precious metals as protection against inflation, currency weakness, and financial uncertainty. During times when people feel less confident about the stability of the financial system, metals like gold and silver often attract more attention. That is one reason why movements inside the vault system are watched carefully by experienced traders. Another reason this situation stands out is because the silver market is relatively small compared to other financial markets. This means that changes in demand or supply can sometimes move prices faster than people expect. When inventory drops and trading activity increases at the same time, volatility can appear quickly. Of course, it is important to stay calm and look at the bigger picture. A single inventory change does not automatically mean a crisis or a price explosion is coming. Markets move based on many factors, including interest rates, economic growth, currency strength, and investor sentiment. However, events like this can act as early signals that the market environment is shifting. That is why investors who follow the precious metals market often pay attention to details that most headlines ignore. Small data points today can sometimes become major trends later. Watching vault inventories, margin adjustments, and economic reports together can help investors understand how the puzzle pieces fit. The upcoming non-farm payroll report could play an important role in what happens next. If the report shows strong job growth, markets might expect interest rates to remain higher for longer. Higher interest rates sometimes put pressure on precious metals because investors can earn more yield from other assets. But if the report shows weaker economic momentum, some investors may begin expecting lower rates in the future, which can support metals like silver. Because of this uncertainty, traders around the world will be watching the data very closely. Even small surprises in the report can trigger large reactions in financial markets. When trading margins are already lower and participation becomes easier, those reactions can become stronger. Another interesting point is that institutional investors often prepare their strategies ahead of major economic releases. That means positioning in the futures market can begin building days before the data actually comes out. When we see vault inventory changes and margin adjustments happening during that preparation phase, it naturally attracts attention from analysts and market observers. For long-term investors, moments like this are reminders of how dynamic the precious metals market can be. Prices do not move in straight lines, and short-term volatility is part of the journey. Many experienced investors focus less on daily price moves and more on long-term trends such as global debt levels, inflation pressures, and monetary policy. Silver in particular has gained attention because of its role in the energy transition. Solar panel production alone requires significant amounts of silver, and as renewable energy expands, industrial demand for the metal may continue rising. If investment demand increases at the same time, the supply and demand balance could become even more interesting in the years ahead. That is one of the reasons why conversations about silver are becoming more common in financial media. Investors are beginning to ask whether the current system of trading paper contracts truly reflects the availability of physical metal. Events like sudden vault withdrawals naturally add fuel to that discussion. Here on Safe Haven Wealth, we try to look beyond the headlines and focus on what the underlying data might be telling us. The goal is not to create fear or hype, but to help viewers understand how global markets work and why certain developments matter. In the coming days, the market reaction to the NFP report may provide more clues about the direction of silver prices. If volatility increases, it could confirm that traders were positioning ahead of the report. If the market remains calm, it may simply mean the inventory change was part of normal movements within the system. Either way, this combination of missing silver, lower trading margins, and a major economic report has already caught the attention of many analysts. It is a reminder that sometimes the most important signals in financial markets appear quietly before the wider public notices them. Now, I'm curious to hear your opinion. Do you think the 6 million ounce vault withdrawal and the margin cut are just coincidence? Or could this be the early sign of something bigger developing in the silver market? Share your thoughts in the comments below because these discussions help everyone learn from different perspectives. If you found this breakdown helpful, consider sharing the video with someone who follows gold and silver markets. And if you want more simple explanations about precious metals, economic trends, and strategies for protecting wealth, make sure you stay connected with Safe Haven Wealth by subscribing to the channel. Your support helps us continue bringing clear and useful financial insights to viewers around the world.